In this video, we're going to kind of finish talking about budgets, and we'll want to ultimately kind of create the balance sheet, or the budgeted balance sheet for the company. So let's start with the cash budget. Again, we want to understand the cash flows of the company. So there's three sections to this piece, right? We're going to talk about cash receipts, cash disbursements, and then financing. In the end, we'll be able to combine this with some other information about plant and equipment, etc., that will get us to the balanced budget in the end. So, what does the cash budget look like? Very simply, all these budgets are kind of the same, right? You have a beginning balance, you add some receipts, right? Some money comes in. That gives us the total amount of cash. Then, of course, we're going to spend some cash. Again, if we subtract that out, we're either going to have excess cash or some deficiency. And then in the end, there might be some financing that's needed. We'll have to see about that. And then in the end, we'll have the ending cash balance for this period. So the cash receipts section, we need to know the receipts expected from our primary sources of income. I'm going to need to know any other kinds of receipts, interest, dividends, right? Maybe some sale of assets, other things that we might sell or have a transaction which we receive some kind of funding. And of course, cash disbursements, exactly the opposite. We have to pay for materials and labor. We have to pay for the overhead components, selling administrative expenses. Again, there might be some anticipated asset purchases. So all of these go into the receipts and the disbursement section. Finally, the financing section, we're going to look at how did we finance this? Are there any expected borrowings? Are we going to repay some borrowed funds? Is there any kind of interest payment that we have to worry about? So those are the components of the cash budget. So we have to prepare this in sequence, right? We need to know the ending cash balance for one period. That's the beginning cash balance of the next period. We're going to gather information from other budgets. Sometimes it's prepared for the year on a monthly basis, right? Or it could be quarterly. However we want to segment these time periods, that's how we're going to choose that. And this is going to help us contribute to some better cash management, right? Especially if we can break this down maybe into monthly. It can help us to understand when cash is going to be needed at certain times of the year and maybe when it's not going to be needed, right? So we're going to have this cycle of business throughout the year where sometimes we'll have more cash than we need. Sometimes we won't have enough. So we're going to have to manage those balances. So let's get started with this cash budget, right? So first of all, we have to have a schedule of collections from our customers. So when customers buy from us, how do we receive the money? So in this case, we say, look, 60% are collected in the quarter that we sell them. 40% are collected in the following quarter. So if we have $100,000 in sales this quarter, we expect to get $60,000 of that today or this quarter. The other $40,000 will come in the next quarter. Accounts receivable started at $60,000. So now we can start to understand a little bit about how the flow is going to happen from collections. So the very first quarter, we had $60,000. Oops, I'm sorry. Here are the quarterly sales, right? For this company, this is Hayes Company. 180, 210, 240, 270. And what we have said is what? 60% of that comes in the quarter that we start, right? 60% of 108,000 is 108. Right? Now, don't forget, we started with 60,000 in accounts receivable in the beginning. Of course, we expect to get those. That's from last quarter. We expect to get that this quarter. Again, here's for in quarter two, we get the other 40% is received in quarter two. So we see we have what? Cash comes in the first quarter, then the rest comes in the next quarter. And this continues on. So now we have, from our sales, we have an understanding of the collections by quarter for this particular company. So now we have to look and say, well, what about payments, right? What about some disbursements maybe? So direct materials, 50% are paid the quarter we buy them, we receive them, 50% are paid the next. We start out with 10,600. So it's a very similar kind of process, right? And we started off, this is how much money we owe from last quarter. Here's the first quarter's payments that we expect. Half of it this semester, or this quarter, half the next semester's quarter. So now again, we add these up. Now what do we have? Total payments for our direct materials. And again, down here, they show us how we calculate those using 50%, a pretty easy kind of an exception. So now what do we need to do? Well, let's look at the cash itself. The cash balance is expected to be $38,000 on January 1. We want to maintain a balance of at least $15,000. We have some short-term investment securities that we expect to sell for $2,000. Direct labor, 100% is paid in the quarter that it's incurred. Manufacturing overhead, selling expenses, and all these other items, except depreciation, are paid in the quarter in which they are incurred. So let's work our way down through now some other particular assumptions. We're going to have to buy a truck in the second quarter for $10,000. We're going to make equally payments for taxes of $12,000 for annual taxes. And then loans are going to be repaid in the earliest quarter where there's sufficient cash, right? So again, if we have extra cash, we're going to make payments of that extra cash. So now we end up with, what we can do is complete our cash budget. See if I can make this a little bit bigger for us so we can see a little bit bigger. There we go. So here's our beginning cash balances. Here's our collections we talked about. We told we're going to sell some securities. Total available cash then is the subtotal of all of that. Now we have taken into our account our disbursements. All the disbursements we've expected, when we expect to make those payments. So here we'll go across. So now we have the total disbursements. So now we need to figure out the excess. You just take the cash available minus the total disbursements. So here's the cash we expect every quarter at the end of the quarter. And if you remember, one of the things we said is we expect that we're going to have a $15,000 minimum. So in this second quarter, you notice that we only have $12,000 at the end. So what we're going to have to do is borrow $3,000 to bring us up to the $15,000. Now, what do we do then? Then the next period, we're going to pay that back, including the interest that we owe on that. So again, this is just a very, it looks a little complicated, I guess, but if you think each one of these line items has a rule, right? You follow that rule, you put the calculations out here, and then we end up with the ending cash balance at the end of the period. So now, what do we do with the balanced budget sheet? Now we have to think about the financial position at the end of the budget period, right? So what information do we need to know? Well, we need to know about plant and equipment, common stock, depreciation, right? We need to know about the retained earnings of the company at the end of the last year. So what's the ending cash balance? Again, we figured that out. It's $37,900. Accounts receivable, remember it's 40% of the fourth quarter sales. That was a rule that we followed. The desired ending inventory is 1,000 units. Showed that in our projection budget. And again, we have the total cost. Remember, it was $44 a unit. What about raw materials inventory, right? So the desired ending inventory, we had 1,020 pounds is what we said we were going to have at the end of the period, times the total cost of $4. Again, that comes from our direct materials budget. What about building and equipment? Balance is 182,000. Don't forget we bought a truck. So that gives us the total balance at the end of the period. Accumulated depreciation, again, we had the 28,800 is what we started with. Then we had the 15.2 from the manufacturing overhead budget. Again, that's part of an illustration earlier. And then we have 4,000 in depreciation shown in the selling administrative expense budget. So it's not just plant and equipment that get depreciated. It's also the items from our other assets that we own in the company. Information about accounts payable. Again, we stated in an earlier example, it's 50% of the fourth quarter purchases. That's what we'll have at the end. Common stock is certainly not going to change in this instance. Retained earnings, the balance was 46,480. Now we also have income of 47,900 from our income statement. This stuff all lines up now with this very big and long example that we've had throughout this video. So now what does the balance sheet look like? Again, we just compare these line items. Where did they come from? They've come from assumptions within the above videos that we've been talking about. The cash budget, the disbursements budget. We've added these other line items that we needed to understand where they came from and how we developed them. So this is our completed budgeted balance sheet. So now we have an income statement and we have a balance sheet that are budgeted. This is what we think it's going to look like at the end of the year. Now, just to kind of take a step further in this example, let's think about different types of business. What if you're a merchandiser, right? So merchandisers don't have raw materials, right? So they're going to have a purchases budget instead of a production budget, right? They're not going to use manufacturing budgets. So they have budgeted cost of goods sold plus any desired inventory that they need at the end. Subtract out the beginning inventory is going to leave them with their required merchandise inventory. So here we have an example. We've estimated budgeted sales are going to be 300,000 and then 320 in August. Cost of goods sold, 70% of sales. Ending inventory, 30% of the following month's cost of goods sold. So how do we figure out the purchases budget? Budgeted cost of goods sold is 70% of the 300,000. That's 210. Ending is 30% of the 224. That's from the month before. Total $277,200. Our beginning merchandise that we started off is 30% of the 210. That gives us 63,000. So now our required merchandise purchases for the month, we're going to have to purchase $214,200 in order to purchase the inventory that we need for that month's sales. What do you do with a service company, right? They don't have inventory. They don't sell anything. So in this case, we're going to have to look more at our staff than towards the inventory. So what if we are overstaffed, right? We're going to have higher labor costs. They're going to be lower profits because those additional kinds of salaries and staff turnover is going to be greater, most likely because of a lack of challenging work. If we're understaffed, again, we're going to lose revenues because they can't get the work done. And again, we may lose professional staff because of the excess workload. So how do we manage the labor budget for a service company? Again, we have to set up some basic rules, right? How are we going to, what kind of services are we going to do? We're going to do 300 small loans, 200 medium loans, 100 large loans. So here's the work we're going to do, the service we're going to provide. How much time does that take? So this means what? The total required direct hours, 300 yards at an hour a yard. That's 300 total direct labor hours. What's the cost per hour? $15 per hour we got going here. So that's then going to be able to calculate the total direct labor cost. So for merchandising, we have to come up with a purchasing cost. For service, we have to come up with a labor cost. So in the end, how does this all relate to other industries as well, right? What about not-for-profits, right? I mean, not-for-profit is really not for tax, right? We still have to have more money come in than money goes out. So the budget profit differs for the profit-oriented company. So it's really going to be worked on cash flows, not on revenues. But we still have to have a positive cash flow stream. So we're usually going to start with expenditures, not receipts. So the task is to find the receipts that you need to support the expenditures, right? So again, the type of business just switches the gears just a little bit, whether it be service, whether it be merchandising, whether it be manufacturing. We still need to plan for business. We have to plan for the overall operations of the company. And I hope this was useful. I'll see you in the next video.